when I come to the conclusion that gold trading at nominal all-time highs is still dirt cheap, people just shook their heads and cannot believe what this Stoeferle guy is saying. But you know, on an inflation adjusted basis, gold is still way below the all-time highs. The base, the higher the space, something like that. So could we go to $4,800, which is our long-term target that we explained in our In Gold We Trust report 2020 for the very first time? Yes, definitely.
The price of gold has been on a remarkable upward trajectory in recent months, shattering numerous price records and attracting the attention of investors across the globe. Gold has set multiple new record highs this year, starting its upward surge in March 2024 when the price climbed to $2,160 per troy ounce. Since then, gold has continued to break significant milestones, including an all-time high of $2,483.35 per ounce last month. However, even that record was short-lived, as gold reached its fifth milestone of the year on August 13th, surpassing $2,506 per ounce. This sustained price increase is helping to draw in a new wave of participants to the gold market. Ronald-Peter Stoeferle, fund manager and managing partner of Incrementum AG, concludes that despite gold trading at nominal all-time highs, it is still dirt cheap. Stoeferle believes that on an inflation-adjusted basis, gold remains significantly below its historical peaks. He argues that when compared to other asset classes or certain monetary aggregates, gold is still undervalued. Gold prices are anticipated to rise to $2,500 per ounce by the end of 2024, according to estimates from JP Morgan Research. Citi Global Research shares a bullish outlook, projecting gold to reach $2,500 per ounce in the short term and $3,000 per ounce within the next 12 months. Goldman Sachs also forecasts gold at $2,700 per ounce by 2025, driven by strong central bank purchases, potential U.S. interest rate cuts, and ongoing geopolitical tensions. VanEck sees a positive outlook for gold in 2024 and beyond, with strong demand fueled by central bank purchases and economic uncertainties. They predict gold could reach $2,800 per ounce in 2024, supported by potential Federal Reserve rate cuts and persistent inflation. Over the next 5 years, 2025 to 2029, prices might climb to $3,000 per ounce, though there is a possibility of a decline to between $1,850 and $2,000 per ounce. Stoeferle emphasizes the significance of understanding the gold culture in emerging markets. Additionally, Stoeferle mentioned that reaching $4,800 per ounce, which is Incrementum's long-term target, is a realistic possibility. Before we jump into more content, consider subscribing and enabling notifications to stay updated with our latest uploads.
When I come to the conclusion that gold trading at nominal all-time highs is still dirt cheap, people just shook their heads and cannot believe what this Stoeferle guy is saying. But on an inflation adjusted basis, gold is still way below the all-time highs. If you calculate gold versus most of other asset classes, it is still pretty cheap if you calculate it via some in comparison to some monetary aggregates. I would say that gold is really cheap, and in this bull market, probably like halftime or the fourth or fifth inning, something like that, you can see that we are still trading roughly $200 below the nominal all-time highs. So from my point of view, Kai, the gold is trading. It is kind of a early bull market action that we're seeing. We should not forget that it took us basically 4 years to break out of this consolidation phase, and it seems, and this is really one of the key takeaways of this year's In Gold We Trust report, that the majority of Western financial investors hasn't joined the party yet. I think you can basically see that if you have a closer look at, for example, the ETF flows. We're still on a net basis. We're still seeing outflows from the gold ETFs in 2024, even though we are seeing such a bullish price setup. While on the other hand, Eastern investors, especially obviously China and India, but also countries like Vietnam have been pretty strong recently. Thailand, Japan, obviously. It seems that the marginal gold buyer isn't the Western financial investor, but rather the physical gold buyer in emerging markets. And I think that we here in the Western world, and this is really something that I'm pounding the table on when I'm speaking at big conferences. I think we should all travel a little bit more to emerging markets, talk to people um, about their gold culture, about their gold affinity. So I was really, I did a big keynote in Dubai last year in November. My partner Mark will go there again. And, you know, if you talk to gold traders from China, from India, from the Arabic world, from Turkey, obviously, you can tell that they really know their gold. They're working on a different time frame, I would say, much more understanding the really the big picture. Topics like de-dollarization is just normal to talk about for them. Um, and you know the numbers are clearly confirming this kind of anecdotal evidence, because you know just Dubai is nowadays responsible for 25% of all gold trade now.
The surge in gold prices has been fueled by record-breaking purchases from central banks and a growing trend among investors to increase their allocations to the precious metal. Investment in gold bars and coins has seen a significant rise, particularly among buyers in China, India, and Turkey. Gold has also become one of the most financialized commodities, with 38% of its average annual net demand coming from investments and 18% being held by central banks as part of their reserves, according to data from the World Gold Council. The doubling of gold purchases by central banks, exceeding 1,000 tons in both 2022 and 2023, combined with the rising demand from emerging markets across all categories, has driven the metal's price beyond traditional pricing relationships. Stoeferle observes that many emerging market central banks are still underweight in gold allocation. In a world marked by deglobalization and increasing geopolitical tensions, he believes gold will continue to play a major role as a neutral monetary asset with no counterparty risk. Let's now turn our attention to the video again.
Gold's job is to protect your purchasing power and nothing more. Gold won't probably make you rich overnight, but it won't make you poor. But I think, you know, as you know, we've got some fun charts where we show the long-term purchasing power of gold. For example, at the Munich Oktoberfest, we did the same. As I love skiing. We did the same with ski tickets in the Austrian Alps. We did the same with iPhones. We did the same quite recently. Gold's purchasing power measured in gasoline. And you can just say that gold has done its job pretty well of protecting purchasing power, measured in not only in goods that become better, like the iPhone, for example, and more expensive, but also in standardized goods, like gasoline and beer, for example. But Kai, what I think is pretty interesting is the fact that I briefly mentioned that central banks in emerging markets are now really they have become a very significant buyer of gold. So before that's on slide 45. If you want to show that to the audience,
Yep.
Before the outbreak of the Ukraine war, central banks on average bought 118 tons of gold. Now, since the outbreak of the war, on average, it's 279 tons. So this is really significant. And I had a look at quite recently. I did study the World Gold Council survey since the year 2019, where basically they asked the asset managers sitting in the world's central banks, what strategies they're following, and from 2019 to 2024, an average of 78% of all respondents managed gold reserves separately. However, I think it's really interesting that they are increasingly seeing gold as a strategic asset. So in 2019, only 15% of central banks considered that gold is actually a strategic, a long-term reserve asset. And by 2024, 71% of all those central bank asset managers are saying that it's actually a strategic asset. So if you have a look, for example, at the gold allocation of most of the emerging markets central banks, then you can tell they're still heavily underweight. So I would say, in this world of deglobalization, where it's a world that is basically breaking into two different blocks or whatever.
In the final months of 2024, the gold market has undergone significant changes. Gold prices have started to rise rapidly once again, and experts predict further increases due to ongoing political instability. This raises the question: what factors will determine the dynamics of gold prices in the near future? And what can we expect at the end of 2024 and the beginning of 2025? We want to hear from you. Feel free to leave your thoughts in the comments, give a thumbs up if you liked what you saw, and subscribe to stay connected with our ongoing exploration.